Welcome to The Explainer. I am absolutely thrilled you're here today because we're going to explore a massive financial blind spot. It turns out the wealthiest people operate on a completely different set of rules than the rest of us. Think about it. They don't use their own money for those massive homes. They aren't using their own money for their thriving businesses. And they definitely aren't using their own cash for luxury cars or billion-dollar company acquisitions. Nope, it is all financed. Okay, let's dive into this because this single concept challenges pretty much everything most of us were taught growing up, right? I mean, the average person walks around with this deeply ingrained belief that borrowing money makes you poor. We're taught to avoid debt at literally all costs. But the ultra-wealthy, well, they know something completely different. They know that borrowing, when done the right way, is exactly what makes you richer. So let's break down financing in the absolute simplest way possible to see how it can either build ultimate wealth or, honestly, become a complete trap for your future.
Section 1. The secret of financing.
So there's this fascinating duality here. On one side, you have the average person's view, which is that borrowing makes you poor. Debt is a cage, right? But then over on the other side, you have the view of the wealthy. They see that borrowing the right way actually builds wealth. To them, it's a ladder. And this complete difference in perception dictates how these two groups of people navigate their entire financial lives. It's not about avoiding debt, it's about fundamentally understanding how to use it.
Let me tell you a quick story about two friends, Ali and Ahmed. Both of them have the exact same dream. They want to start a coffee shop. Now, Ali takes the traditional path. He puts his head down and spends 10 grueling years saving up enough cash to finally open his doors. Ahmed, on the other hand, walks into a bank with a solid business plan and secures a loan. Ahmed opens his shop immediately. And this brilliantly illustrates the point, because by the time Ali finally saves up enough of his own money 10 years later, Ahmed has already used his profits to open 3 more locations. So who wins here? Well, assuming Ahmed actually makes good coffee, he absolutely does. He essentially used tomorrow's money to create massive opportunities today.
So what actually is financing at its core? It really just means getting money now and paying it back over time in installments. Instead of waiting years to afford something, like our guy Ali did, you borrow the funds up front. And this is the exact mechanism used for buying a house, starting a business, purchasing heavy equipment, expanding a company, or even paying for education that increases your earning potential. Without financing, so many of the incredibly successful businesses we see around us today simply would never exist.
Section 2. How banks really work.
Now, what's really interesting about this concept is how it dispels one of the most common myths out there. A lot of us subconsciously think banks just have these endless vaults of cash, or that they literally sit around printing money all day. Well, they don't. Banks do not print money, they just move it around. They're essentially just highly organized middlemen in the flow of capital.
Let's walk through exactly how this movement happens chronologically. First off, step 1, thousands of everyday savers deposit their hard-earned money into a bank for safekeeping. Then, step 2, the bank pays those savers a very, very small amount of interest for the privilege of holding onto their money. Now for step 3, and this is absolutely the crucial one. The bank turns around and lends that exact same money out to borrowers, but at a much higher interest rate. Finally, step 4, the bank keeps the difference between the high interest they charge and the small interest they pay out. That difference? That is their profit. And this is exactly why banks actually want people to borrow money. As long as they believe you're going to repay the loan, your borrowing is the actual engine of their entire business model.
Section 3. Good debt versus bad debt.
You see, there are two entirely different paths when it comes to financing. On one hand, we have assets. Assets are things that make you money and create real long-term wealth. But on the other hand, we have liabilities. Liabilities are things that cost you money every single month. They just drain your resources and ultimately they create massive emotional and financial stress.
To make this crystal clear, good financing goes toward assets. We're talking about things like business loans, buying a rental property that generates monthly income, purchasing necessary equipment for your company, or funding an education that directly leads to a higher salary. Bad financing, on the flip side, is poured straight into liabilities. This is swiping a credit card for expensive gadgets you don't really need, taking luxury vacations on borrowed money, buying designer clothes on credit, or financing cars that you absolutely cannot comfortably afford. One side of this equation builds a prosperous future. The other side, it pretty much destroys it.
Section 4. 4 major financing mistakes.
Let's quickly punch through the main pitfalls people tend to fall into here. Mistake number 1 is simply borrowing more than you can realistically repay. It's over-leveraging yourself. Mistake number 3 is financing things that lose value quickly. like a brand new car that depreciates the second you drive it off the dealership lot. And mistake number 4 is taking out loans without an emergency plan. I mean, what happens if you lose your job? What if your business has a terribly slow month? Smart borrowers always plan for unexpected setbacks.
But let's hit pause for a second and focus on mistake number 2, which I skipped just a moment ago, ignoring interest rates. That massive thousands of dollars figure, that represents exactly what ignoring the fine print is going to cost you. A tiny, seemingly insignificant difference in an interest rate on a mortgage or a long-term business loan doesn't really look like much on paper today, but over the 10, 20, or 30-year life of a loan, that tiny percentage point compounds into thousands, sometimes tens of thousands of dollars right out of your pocket. You have to pay attention to the math.
Section 5. Mastering the fire.
Let's move ahead and see how this actually builds wealth in the real world. The wealthiest entrepreneurs, they don't wait until they have all the cash on hand. But, and this is key, they also don't just borrow as much as humanly possible just for the fun of it. The golden rule is this: if a business or an asset earns more than the cost of the loan, financing becomes an incredibly powerful tool for growth. They use money strategically. The goal is never to just amass a bunch of debt. The goal is to borrow wisely so the asset actually pays off the debt for you while you get to keep the profit.
So the crucial point is summarized perfectly by this analogy. Financing is like fire. Used carefully, it can power homes, businesses, and entire economies. Used carelessly, it can burn everything down. The debt itself is completely neutral. The loan isn't the difference between success and failure. The difference is entirely in how you, the borrower, choose to use it. I want to leave you with this final, absolutely critical question to ask yourself: will you use debt for consumption to create long-term problems, or will you use it to acquire assets and build lasting opportunity? Because the smartest financial decisions start with genuinely understanding how the system works. If this explainer shifted your perspective today, please share it with someone you know who is maybe still trapped by the myth that all borrowing is inherently bad. Let's change the way we think about wealth. Thanks so much for learning with me today, and I'll catch you in the next one.